welcome back to the deep dive. You know how it goes. We take stacks of complex financial reports, distill them down, and give you the essential analysis, the shortcuts to being instantly well-informed. Today, we are diving headfirst into the high-stakes world of cybersecurity investing.
Yep.
Early this month, the three titans, Fortinet, Palo Alto Networks, and Zscaler, all reported their latest quarterly results.
And the market reaction was, well, it was fascinating. Despite really robust growth across the board, all three saw their stock prices dip right after the announcements.
Which tells you something right there.
It tells us a critical story. Expectations in this sector are just astronomically high. So our mission today is to unhack these reports, analyze their competitive moats, and, ultimately help you answer a central question.
Which is?
Which of these giants offers the most compelling growth and value proposition right now?
That is the crucial needle we need to thread. But first, for you, our dedicated listener, we have to emphasize this.
Absolutely.
This analysis is purely for informational and educational purposes only. We are just analyzing the source material. It is not financial or investment advice.
That's right. You must, without exception, perform your own independent research. We're here as guides to the data, not fortune tellers.
Okay, so let's begin. Section 1, the scorecard. We need to understand not just what the numbers were, but I think the quality of that growth.
And why the market reacted so negatively despite the headline beats.
Let's start with Fortinet, FTNT, which reported Q3 FY25. They look strong on the surface. Where did they deliver?
Fortinet was extremely consistent, beating consensus on both the top and bottom lines. Revenue grew 14% year over year to $1.72 billion.
And billings were right there with it.
Matched that pace, $1.81 billion, also 14% growth. But what really stood out was the strength of their legacy business.
Hardware.
Exactly. Product revenue surged an impressive 18%. That really affirms their position as a dominant hardware player.
Yeah.
However, the market focused elsewhere.
On the services side.
On the services side. We'll get into the risks later, but the immediate investor apprehension stemmed from that adjacent services revenue line, which is, crucial for recurring stability.
Okay, so let's pivot to Palo Alto Networks, PANW, reporting Q1 FY26. Their numbers always involve big figures reflecting their enormous scale.
They continue to show impressive execution. Total revenue hit $2.47 billion, which is a solid 16% year-over-year increase.
But the number everyone watches is their next-gen security AR.
That's the one. NGS annual recurring revenue. It's the measure of their high-value, pure software cloud subscriptions.
And that's where the momentum really is, right?
Absolutely. NGS ARR increased a very robust 29% year over year, hitting $5.85 billion.
Wow, 29%?
Yeah. That 29% growth rate is the high-quality, repeatable revenue that justifies their premium valuation. It shows their platformization strategy is working.
Customers are consolidating.
They're consolidating their software spend right onto PANW's cloud offerings.
That 29% NGS growth sets a pretty high bar. So how did Zscaler, the cloud-native disruptor, stack up with their Q1 results?
Zscaler, or ZS, continued its aggressive expansion. They reported revenue growth of 26% year over year, which came in at $788.1 million.
And they were profitable, on a non-GAAP basis at least.
They were. They also delivered strong non-GAAP net income of $159.5 million. This company is clearly scaling rapidly and efficiently in the cloud.
Wait a second. If Zscaler delivered 26% revenue growth and increased their non-GAAP net income, why did the stock take such a dive? That seems completely counterintuitive.
That is the perfect question that defines the hypergrowth sector. The dive really reinforced two key points.
Okay.
First, Zscaler is valued for acceleration, and 26% growth, while fantastic, was just below the whisper number of acceleration some analysts had hoped for.
So it's about the rate of change.
Precisely. And second, while that non-GAAP net income looks great up significantly year over year, they still report negative GAAP net income. For Zscaler, the market demands perfection on growth while being hyper-aware of the valuation.
So any slight miss, even if the business is humming along, triggers a correction.
A sharp correction. And you can see the difference in quality right there. PANW is growing its most desired recurring NGS revenue at 29%, slightly outpacing Zscaler's 26% total revenue growth.
That helps put the market reaction into context. It's not just about beating the estimate, it's about beating the narrative. Okay, let's unpack this further in Section 2, where it gets really interesting.
The core strategy.
The core strategy. We're talking competitive moats and how they're tackling the massive pivot toward AI security.
And we have three fundamentally different approaches here, which is, I think, critical for the listener to grasp. Fortinet's moat is built from the ground up, literally, in silicon.
You're talking about their custom chips.
I am. They boast a wide economic moat anchored by their proprietary FortiASIC technology.
So what exactly is FortiASIC, and why does a chip matter so much in a software security deep dive?
It matters immensely. FortiASIC is a dedicated, custom-designed chip accelerator. Unlike competitors who rely on general-purpose CPUs, Fortinet uses this ASIC to deliver specialized security functions at far higher speeds.
How much higher?
We're talking 5x to 10x better performance. This allows them to process vast amounts of traffic faster and more power efficiently.
And that hardware advantage feeds directly into their business case.
Directly. Speed means higher throughput, and efficiency translates into a lower total cost of ownership TCO. Fortinet claims they reduced TCO by 1/3 compared to peers.
And that's a sticky advantage.
Very sticky, and it's further locked in by their unified FortiOS operating system.
So the hardware creates the efficiency moat, which then supports their software growth. What specific growth pillars are leveraging that?
They are seeing great organic traction. Their unified SASE billings grew 19%, but within that, their cloud-delivered FortiOS offering grew over 100%.
100%.
Over 100%. More critically, their AI-driven SecOps security operations was their fastest-growing pillar, with 33% billing growth.
And they're also big in OT security, right?
Dominating the niche but rapidly expanding operational technology market, growing over 30%. This blend of efficiency and targeted growth is why they often hit the rule of 45.
Which means their growth rate plus their free cash flow margin equals 45 or better.
Signifying really strong financial discipline. It's the classic profit-first model.
Okay, a totally different approach from Palo Alto Networks, PANW. They rely on scale and aggregation. Their strategy is platformization.
Exactly. PANW's moat relies on being the single pane of glass, consolidating all the fragmented security point solutions an enterprise might have. They acquire, integrate, and sell the ecosystem.
And this is all fueled by data.
Massive amounts of data. Their XM platform processes an astonishing 15 petabytes of data daily. That volume of input is what allows them to build truly sophisticated AI solutions like Prisma AIRs.
But their strategy also involves aggressive M&A. I mean, they just announced the acquisition of Chronosphere for $3.35 billion to push into observability. That is a huge commitment.
It is.
Doesn't such an aggressive acquisition strategy introduce, material execution risks?
Yeah.
Or maybe dilute their focus from core security?
That is the central risk investors have to weigh. Chronosphere is a bold move. It takes them beyond security and into monitoring the operational health of cloud applications.
So what's the argument for doing it?
Management argues this makes them a more comprehensive partner. If they own observability, they can secure it better, and their success is evident. SASE AAR is topping $1.3 billion. They're serving 1/3 of the Fortune 500. They're betting the market values simplicity above all else.
Even if it introduces integration complexity on their side.
Even then.
And then we have Zscaler, the ultimate cloud pure play. They're actively disrupting the very network topology that companies like, Fortinet were built upon.
Zscaler operates entirely differently, built on a cloud-native, zero-trust architecture. The core concept is simple. Never trust, always verify.
So they route all traffic through their own cloud.
All of it. Through their cloud proxy, removing the need for traditional firewalls at corporate headquarters. This fundamentally appeals to companies migrating heavily to the cloud. Their stability isn't tied to hardware sales, it's tied to their backlog.
Their RPO.
Their immense revenue visibility. They have a $5.8 billion remaining performance obligation, or RPO. For the listener, RPO is essentially guaranteed, contracted future revenue that hasn't been recognized yet.
And that backlog gives them incredible stability.
And confidence in their forward guidance.
So how are they capitalizing on the AI security mandate?
Like PANW, they're aggressively leveraging acquisitions. They recently acquired SPLX specifically to secure the enterprise AI lifecycle.
What does that mean exactly?
It means focusing on shift-left AI asset discovery and automated red teaming. Since Zscaler sits between the user and the internet, they are perfectly positioned to monitor and secure access to cloud-based AI tools before data ever leaves the enterprise.
Okay. Every deep dive needs a reality check. That brings us to Section 3, the catch risks, guidance, and valuation. We've seen the growth. Now let's look at the risks priced into those post-earnings dips.
Starting with Fortinet, the risk is structural deceleration. We mentioned the strong product sales.
But the market fixated on services.
It did. The service revenue growth was 13% in Q3. This marks the ninth consecutive quarter of slowing service revenue growth, and service revenue is the stable, high-margin, predictable component of the business.
Wow, 9 consecutive quarters. That is a staggering streak of deceleration. Why should that worry an investor so much?
Because it signals a fundamental slowdown in the velocity of customer recurring spend. Management tried to assuage concerns, but they admitted improvement isn't expected until the latter half of 2026.
The second half of 2026, that's a long way off.
It is. This slowdown, combined with soft Q4 guidance, projecting only 12% growth at the midpoint, is why the stock dipped. It overshadowed the strong profitability.
And what about valuation?
They trade at a TTM PE of 33.04. While profitable, the stock price, around $85, is currently above the stated fair value estimate of about $79. So there's caution there, given the growth concerns and the added risk of ongoing class action lawsuits.
Right. Now, Palo Alto Networks doesn't have that same growth deceleration issue, but their risk is clearly valuation. How do they justify that price tag?
They trade at a much steeper forward multiple, a forward PE of 49.26. The stock is currently trading right up against its estimated fair value, $200.90 versus $204.10.
A forward PE of nearly 50 means the market is already pricing in near-perfect execution.
For the next few years, yes. The justification lies in their commitment to cash generation. Management is confident they can maintain stellar free cash flow, or FCF, margins of 40% or more by FY28.
But every large acquisition like Chronosphere introduces immediate integration risk.
It absolutely does, and the potential distraction that could threaten those FCF targets. Investors really need to believe in the management team's ability to seamlessly integrate complex products while accelerating core growth.
And Zscaler seems to have the highest reward potential, but also the highest immediate risks reflected in its valuation.
That's correct. Zscaler has the steepest valuation hill with the highest forward PE at 65.98. The stock is priced for maximum disruption.
And that premium reflects their cash flow.
It reflects their strong FCF margin, which is nearly 30% TTM, showing the underlying efficiency of their cloud model. However, we have to revisit the nuance between profit metrics.
The GAAP versus non-GAAP numbers.
Exactly. They report negative GAAP net income totaling negative $41.04 million TTM. This is the cost of hypergrowth. Zscaler is investing heavily in sales, marketing, and R&D to capture market share.
So investors are betting that the strong cash flow will eventually translate into GAAP profitability once the scaling slows down.
Precisely. It's a trade-off, high growth for high multiple. And they also face M&A risk, particularly with their integration of Red Canary, a managed detection and response platform.
And that segment can have higher churn.
It's sometimes associated with higher customer churn, which could destabilize their excellent revenue visibility from that massive RPO.
Okay, so what does this all mean? If we put these three cybersecurity titans head-to-head for an investor looking to capture industry growth, what's the definitive summary?
The comparison, I think, boils down to three distinct investment profiles.
Okay, let's hear them.
First, Fortinet, FTNT, is the established value play. Their strengths are tangible. The cost advantage from FortiASIC, high profitability metrics like the Rule of 45, and, high net income.
And the risk?
The risk is structural. You are betting that they can stabilize or re-accelerate that critical service revenue. Otherwise, their valuation multiple will compress toward other hardware-heavy peers.
Got it. Number two.
Second, Palo Alto Networks, PANW, is the comprehensive platform leader. They have demonstrated massive growth in their most valuable segment, NGS ARR, and have aggressive long-term targets. They promise total security via consolidation.
And the trade-off there?
You're paying a high current valuation, and you're accepting the complex integration risks for the promise of high growth scale and cash flow margins above 40%.
Okay, and finally, Zscaler.
Third, Zscaler, ZS, is the pure-play zero-trust innovator. They offer extreme growth potential and outstanding revenue visibility via that $5.8 billion RPO.
But that potential comes at a steep price.
It commands the highest valuation multiples and requires accepting negative GAAP profitability as the cost of rapidly scaling their cloud-native market disruption.
If we connect this to the bigger picture, all three are clearly capitalizing on the mandatory AI security trend, but they are approaching it with fundamentally different business models.
Absolutely. Fortinet through ASIC acceleration and cost advantage, PANW through broad platform consolidation and massive data processing.
And Zscaler
Hmm.
through cloud-native zero-trust architecture and proximity to the user.
And this raises an important question for you, the investor. When looking at hypergrowth sectors like cybersecurity, should you prioritize established, predictable profitability metrics like those consistently seen at Fortinet? Right. Or should you accept those significantly higher valuation multiples for the promise of rapid market disruption offered by Zscaler and Palo Alto Networks?
That distinction, profitability versus disruption, is the key takeaway from these earnings reports. And it's clear there is no easy answer, only trade-offs. A final reminder that this analysis is based purely on the source material we reviewed and is for educational purposes only. Always conduct your own thorough research before making investment decisions.
Please do.
Thank you for joining us for this deep dive into the cybersecurity titans. If you found this analysis helpful, please take a moment to hit that like button and subscribe to our channel. Your engagement supports this work and makes sure you never miss our next critical analysis.